Good afternoon, everybody. Welcome to our first quarter update call. I'm Jennifer Klein, Head of Wealth Management at Cambridge Trust. It's wonderful to be looking out on a bright sunny day in springtime and looking forward to the warm weather upcoming in the summer. I'd like to remind you that we are recording this call and it will be posted on our website in the next couple of days. Also, please feel free to add any questions you have. There's a box at the bottom of your screen called Q&A, and you can add any questions as we go along. Today, I'm joined by four of my colleagues: Dave Lynch, Chief Investment Officer; Steve Zarl, Co-Manager of our Sustainable Investing Portfolios and our Bank Analyst; Marie Del Rossi, Senior Fiduciary and Trust Counsel; and Will Fleming, a Relationship Manager in our New Hampshire office. On the investment side, Dave will give us an overview of the markets and our current positioning, and then Steve will discuss our thoughts on the financial sector. Marie and Will plan to discuss recent news regarding estate planning and possible changes in mass and federal tax laws. As Steve discusses the banking sector, I do want to remind folks that as employees of Cambridge Trust, we are not allowed to comment specifically on our stock. I will note that in these challenging times that we have strong capital and liquidity positions with $2.7 billion in liquidity available, and we're very well positioned for the current environment. The presentation will go for about 25 minutes, and then, as I said, we'll take your questions, so feel free to add those. I will now turn it over to Dave Lynch, who will start us off. Dave.
Thank you, Jennifer. Good afternoon, everyone. I'm going to go quickly through some prepared slides. I'm happy to elaborate on anything in Q&A. So first and foremost, let's start with page 3 on the U.S. debt ceiling. It is front of mind, front of newspaper, front of television news right now, appropriately so. It's a big and important topic, but I will say, I think that default is being a bit exaggerated in the current context. Yes, a technical default is possible where some payments are delayed or missed. However, a true default where we're going to disavow our debt as unwilling or unable to pay is not really in play whatsoever from any side of the political aisle. The risk here, though, is that the brinksmanship along the way is damaging our global standard as a bond and currency safe haven. Could take some time to repair that. We do think there will be a resolution before the so-called X date. I don't want to be cavalier about that. Something could always go wrong. We do think things will get figured out. It remains to be seen how durable and lengthy the extension will be, but we think something will get done. To remember, though, that there will be a knee-jerk sigh of relief market reaction when we are able to cross this off the worry list. It's going to likely come with some degree of concession for less spending or less stimulus of some sort, which has been a large part of what has helped support the market up to this point. So more to follow on that. But on to the next page. Assembled a list here of some of the largest buckets of topics that we as a team are considering and debating. I'll go quickly through them. The first row talks about the U.S. consumer. And on the positive side, the U.S. consumer is typically quite resilient. It doesn't pay to bet against the U.S. consumer, particularly when the job market is so strong, unemployment rate so low, consumer plows ahead. However, that consumer is starting to face more headwinds. The excess savings accumulated by stimulus check and otherwise are starting to be burned off. Student loan forbearance could be ending. Labor market's a little less rosy. Credit card bills are going up, et cetera. So definitely two sides to that coin. It depends on your time frame and outlook where you might interpret the current state of the consumer. Next, inflation. Inflation is cooling, and that's great news. More cooling is likely to come. Statistically, some of the housing data comes through with a lag, and that should also be cooling off. However, it's still too high and too sticky for Fed comfort. And so therefore, the foot will stay on the gas of higher rates and keeping them high until better inflation readings come through. Third row, just talking about current market sentiment. The mood of the market is generally pessimistic. It's pretty baked in. It's almost become too consensus that everyone is nervous about things. And that has put a lot of cash on the sidelines that could re-enter the market and spur a rally. or short covering, or both for a rally. But on the flip side, the caution is certainly warranted. Tighter lending standards will have consequences that will work their way through the economy and stunt growth. Things like commercial real estate, some of the banking stresses are still being sorted out. So there's reason to be cautious and careful on the breadth of risks that are out there. Recession, the odds of recession are growing, and that is growing more consensus. However, on the positive side, if the recession turns out to be mild and the stock market is able to do its usual thing, which is quickly look beyond that to brighter days ahead, the stock market could turn up before the economy fully works through its challenges. So, but even if it is a small recession or mild recession, it's still a recession. So if it's small enough that it only really hits the small cap stocks and the less profitable companies and smaller businesses, those smaller companies and smaller stocks are still in many ways customers of the stock market leadership, the Apples and the other mega tech stocks and consumer discretionary stocks that have led the way. So at some point, there needs to be a reconciliation of that, even to the most successful stocks that are not vulnerable in any material way, but their customers certainly are. So what does that all boil down to? Well, the economy and earnings are tapering off from really a great place to just merely a good place, but it's still a good place nonetheless. And by the way, rate cuts are getting more credibly on the horizon, which tend to be a good thing. However, the negative side, negative interpretation of that is that, yes, rate cuts may be coming, but that will be because the Fed has overdone it. And as the consequences of higher interest rates work their way through the economy, reveal themselves with their lags, we're going to find that things are broken a little more profoundly than is currently showing through. We shall see. Onward then to page 5 and talking a little bit about the U.S. stock market, where fair value is. Obviously, U.S. stocks tend to be the largest component of all of our client portfolios, really sets the mood for the global investing market as well. So it is really the center of things. The market has had a lot to price in. Earnings, interest rates, inflation, recession risks, Russia, Ukraine, debt ceiling. So the question is all of that already in the price? Well, I think a lot of it is, but perhaps not quite all of it. And therefore, we remain moderately underweight stocks. We have an asset allocation meeting tomorrow where I'm sure there will be vigorous debate among our bulls and bears of the team on how or if we should adjust that current stance. That's where we are. What we have done lately is we've increased some of our global diversification, added to international equities. And that has been working better lately as international markets have perked up, at least relative to the US in recent weeks. So we're happy for that global diversification and balance that we have there. A positive sign is that our team, our equity analysts, are starting to find more interesting individual opportunities. I think that's a positive sign that there are opportunities within the market, even though it may be challenged economy overall. Portfolio, of course, remains balanced with cash positions, fixed income positions. Fixed income is in certainly better relative standing currently as the stock market has cooled off some. Onward then to page 6. So what about the U.S. market? Well, it's been very narrow leadership up to this point in the year. It's great to have the market up, but typically broader participation is a sign of a healthier market. It's been very narrow up to this point. So what this slide is showing is that on the left 2 bars, the top 5 largest stocks in the market have done quite well. And those in position rank 6 to 20 have also done quite well. And that has left stocks size in position number 20 to position number 500 in the S&P 500 lagging behind. So the good news, we own many of those top 5 and top 20 positions. We expect to continue owning many of those positions. Our research agenda now is shifting a bit more to barbelling that with sifting through positions 20 to 500 for opportunities on an individual basis. I heard a couple of good pitches yesterday from our equity team on a couple of small and mid-cap ideas that are very individual basis that I think bode well for our opportunity to find some alpha as we go forward. On to the next page. I wanted to then take a bit of a step aside and talk about a broader topical item as I close my remarks here, is just about AI. Artificial intelligence has certainly captured the imagination of the market, of the population at large. generative AI, chat GPT, et cetera. We think that it's a real and transformational development and evolution of the capabilities of technology. There are, of course, societal implications, labor displacement kind of implications that need to be considered in the longer term. But all things considered, we do think that this is real. It will have benefits for the mega tech platforms, as well as some of the equipment providers, semiconductor and chip providers that run these technologies. So we think this is a profound trend. You can see by this chart on the speed of adoption. Only took 2 months to get to 100 million users. So in this chart, a small bar is a good thing or a fast thing. ChatGPT has certainly far outpaced all its predecessors, and we think therefore it's going to stay around, and have more durability than things like online gaming and Bitcoin mining and the metaverse that were sort of the prior things that were going to be the great boon for the semiconductor manufacturers and the tech companies, et cetera. This is even a leg beyond that in our view. So that's early days and early analysis, but there you go, some initial thoughts from us. So with that, I'm going to now hand the microphone over to my colleague, Steve Zarl, who's our senior financials analyst and the portfolio manager on our equity team. He's going to provide an update on the banking industry. Over to you, Steve. Thanks.
Great. Thanks, Dave. Michelle, if you can go to the next slide. I'm going to step back over the next 5-6 minutes and take kind of a broad look at the U.S. banking industry, given its pretty central role in the global economy. To start off with, this bar chart should give you a sense of the size of the assets that sit on the balance sheets of U.S. banks. And it's about $23 trillion worth of assets right now. Like most industries, it is top heavy. So the top 5 players, led by JP Morgan, the world's largest bank, control a good chunk of those assets. But I wanted to focus your attention on the far right bar, the all other. This is inclusive of small banks, community banks, regional banks, et cetera. And they play a vital role, obviously through the asset size that they control. But more importantly, they are important players in lending to consumers, to small and medium-sized businesses. And the point on small and medium-sized businesses, that those businesses control about 50% of the workforce, or employ 50% of the workforce in the US. So small, medium-sized banks are critical components of the US economy. Next slide. As a point of comparison with other countries, the US banking system is somewhat unique, and it is home to more commercial banking organizations, with most of those being those small and mid-sized banks that I was talking about, than any other country in the world, and by a good margin, as you can see on the chart. Over 4,200 banking organizations are chartered here in the US. So why are there so many banks in the US relative to other countries? It's in part has something to do with historical past regulations, which have long since changed, and which made banking across state lines pretty difficult. But really the driving reason, I think, is that regulators such as the Fed, the FDIC, the OCC, they don't want to centralize financial assets in just a small number of banks. In the eyes of regulators, the centralization of power in fewer hands adds concentration risk to the system versus spreading those assets out over many institutions and many geographies. Next slide. So, I wanted to underscore a little further the key role that small and mid-sized banks play within the US banking system. Not only did this group of banks act as a conduit between the US government and many businesses by distributing these essential paycheck protection loans that happened during the pandemic, but they also, as I mentioned before, they're a central source of credit to small and medium-sized businesses and farms, which is highlighted in this slide. And I will say, Jamie Dimon, JP Morgan's well-known CEO, on their most recent conference call with analysts, even called out the importance of small banks to the entire financial system. Next slide. But I would be remiss if I didn't mention the current interest rate backdrop, which is so critical to the banks and obviously the overall US economy. This graph underscores what is an unusual interest rate environment and the unusual rate environment that we've been in for the past 14 months. When comparing the current rate hiking cycle, which kicked off in March of 2022, versus the prior 4 rate hike cycles that are listed on this chart, you can clearly see how different it has been. In prior cycles, the Fed raised rates much more gradually and over longer periods of time. But in the current cycle, with the high inflation, that's going to force the Fed's hand. And they've moved much more aggressively than ever before, which really resulted in the surge in rates over the last 14 months. While questionable balance sheet management and limited business diversification has certainly impacted a select few banks, as we all know over the past couple months, the slope and the magnitude of the change in the federal funds rate certainly played a central role in, call it, the banking tumult that we have been living through. Next slide. But there is a reason that now that we have just passed through Q1 earnings, and I listened to many of the bank CEOs speak, most of them called what we have just come through more a passing storm and certainly not a crisis. You can see in the top part of this chart, deposit outflows, which are down 6.5% from nearly 14 months ago, and just 2.5% below from the pre-Silicon Valley pressure days. They remain $4 trillion above where they were prior to the pandemic. And then in the bottom clip, even before the Silicon Valley and Signature Bank news hit, the banking industry entered 2023 with one of the highest capital levels the industry has ever seen, as determined by regulators. So what this really means is the industry has never been better equipped to absorb unexpected losses and unexpected hurdles that are thrown their way than ever before. Next slide. And then just to round it out here, I wanted to call out the importance of the measures that the Federal Reserve and other regulators took, both to inject additional liquidity or make additional liquidity available to all member banks when needed, by creating what was called the Bank Term Funding Program, which this is a clip of a portion of the press release announcing the BTFP. And then the other part was they made a pretty substantial step for Silicon Valley and Signature depositors to guarantee all the deposits at kind of the point of maximum pain when confidence was ebbing. Those were really big moves to ensure, kind of instill confidence in the banking system here in the United States. So while I'm not saying the period of discomfort has passed, or we're approaching a conclusion, it seems like we are. We as investors are closely watching a few things going forward. And among those are changes in banking regulations, funding costs, and kind of the future trajectory of interest rates, credit availability, commercial real estate, and then what's going to happen with the industry in 2, 3, 4 years. Will there be M&A? Will there be industry consolidation? Those are all things that I watch closely as an analyst, and we talk about as an investment team pretty regularly. So that concludes my remarks on the banks, and I just want to pass it over to Marie Del Rossi to discuss changes in the tax laws.
Hello, very happy to be here today. My name's Marie. I'm very excited to speak to all of you about some potential changes we're seeing with the estate tax law, both federally and in Massachusetts. So what we plan to do here, Will and I, is to issue spot for you a little bit and then call you to action if there are changes that should be made to your estate plan. So first we'll cover the federal estate and gift tax, the sunset and the new dawn that we are facing. We'll look at the Massachusetts tax package that was recently passed by the House, and we will also discuss favorability for using New Hampshire trust law when dealing with making gifts that may be suggested by what I tell you. And will be talking about the Secure Act as it affects your retirement planning. So there's a lot here on the page here on the next slide, and I'd like to trim this down as much as possible so we can make as much progress as possible. So we're talking about the federal estate and gift tax. Our current law, enacted in 2017, allows the federal government to tax all gratuitous transfers during your lifetime or at your death based on the fair market value of those assets when the transfer occurred, unless an exemption, exclusion, or deduction applies. So first, the good news: transfers between spouses do not incur any transfer tax. The next exclusion from tax is the annual exclusion for gifts below $17,000 per year. Many of you may be familiar with this. This is the technique or mode for making gifts to grandchildren most often, other members of the family. Funding an insurance trust is often contingent or uses this ability to make gifts to fund them. So after you've exhausted your $17,000 annual exclusion gifts and generously provided for your family, if you continue to make another gift, charitable or otherwise, you need to take in mind what we call the unified exemption amount. It's unified in the sense that it applies to both lifetime transfers, transfers at death, and any generation skipping transfers. Currently, the unified exemption amount is approaching $13 million per person, meaning that a couple, for example, would be able to transfer over $24 million without paying estate tax today. What we are facing is that this current law will be sunsetting in December 31st of 2025. And our question here is, what do you do in light of that? What will be happening on the eve of 2026 is that very high exemption amount will expire. The following morning, January 1st, 2026, the exemption amount will drop by approximately $6 to $7 million. It is estimated that the new exemption amount will be right at about $6.8 million. So this begs the question, should one be taking action now to take advantage of that higher exemption amount while it is still available? So this brings up the issue of gifting. Unless you are willing to stage your death and move to Mexico, in order to utilize the exemption, you'll need to use it during your lifetime, which means making a gift. So there's much to consider when making gifts, and the call to action for you really is to review your estate plan. Review your assets, asset placement. Do you have appreciating assets? Are they appreciated? Do you have cash? Are you rich in business interests, real estate? Review your own goals, priorities, and achievements when considering whether to make gifts now. Do a gut check. I just made this money. Why should I give it away? If you don't have a good answer to that question, gifting may not be right for you despite the favorable tax environment. One should look at, given the landscape that we're facing, a possible revision to your holistic wealth plan, keeping in mind the need for flexibility, adaptability to make a durable plan, and altogether consider the big picture, not just the tax picture. So now for the Massachusetts estate tax, which is the good news, I would say, the current law is, again, similar to the federal law, gives each individual a $1 million exemption against estate tax. If it applies, there is a steep cliff in terms of when your assets become subject to tax. So below $1 million, no tax at all. Over $1 million, you are taxed from $1. Important to note that there's no gift tax in Massachusetts. The proposed law that is part of the tax package that recently passed the House would increase the exemption to $2 million, which is particularly favorable, especially given market values of real estate. One could get caught simply by virtue of their appreciation their home with an estate tax that they were not expecting. And this exemption gives us a little bit more wiggle room in terms of protecting assets and avoiding tax. The additional benefit of the new law is that we will no longer have to deal with that cliff. If you go over the exemption amount, that's when the tax starts, not at $1. Quick note, in terms of New Hampshire law, there's nothing significant on the books right now, but just to say that if you are considering making gifts, New Hampshire law remains very favorable in terms of taxes and also in terms of just the general trust law environment if you were to utilize trust. So with that, given our time constraints, I am going to pass the baton to my colleague, Will Fleming.
Thank you, Marie, and good afternoon, everyone. I just heard from Marie on potential changes to tax laws in the future, and in keeping with that same theme, I want to talk about 3 changes that have already taken place by way of the Secure 2.0 Act that may have tax implications and/or financial planning opportunities for our clients. But before I do, a little bit of background on the Secure Act. Secure stands for Setting Every Community Up for Retirement Enhancement. The first iteration of the Secure Act was signed into law on December 20th, 2019, really as a means to strengthen the retirement system and to strengthen Americans' readiness for retirement. It included changes such as moving the RMD age, the age at which you must start taking required minimum distributions, from 70.5 to 72. It also eliminated the so-called stretch provision for non-spouse IRA beneficiaries. And it also had several enhancements to retirement plans that are offered by small businesses. But this left a lot of tax advisors and financial planners with unanswered questions, as there were just several nuances that were never fully fleshed out. So fast forward to last December of 22, actually, if you could stay on the previous slide for a second, sorry. The House of Representatives passed the Consolidated Appropriations Act of 2023, and contained in that bill was the second iteration of Secure Act, known as Secure 2.0. So Secure 2.0 is an extremely vast piece of legislation with dozens and dozens of changes, but perhaps a key difference between the first iteration and the second iteration is that in the case of Secure 2.0 in general, these changes aren't going to require the sense of urgency, nor will they impact as many individuals or businesses as the first iteration. So ultimately, we see this as providing a lot of new planning opportunities for our clients. You can go to the next slide. So having said that, let's jump right into 3 highlights from Secure 2.0. And this is by no means an exhaustive list. This is just highlights to consider while planning. The first highlight is the new transfer pathway that was created from a 529 college savings plan into a Roth IRA. Previously, there were sort of limited options for money left over in a 529 plan after the child, or let's say the 529 beneficiary had graduated from school, or for whatever reason didn't eat up all the funds in the 529 while they're in school, or maybe they didn't go to school. But for whatever the case may be, there's money left over in the 529, and 529 plan owners are asking, well, what should I do with this money? They could change the beneficiary to someone else who perhaps has education expenses. They could cash out of the 529, but that would incur a 10% penalty on top of income taxes, which pretty much destroys the tax deferred growth feature of the account. So many 529 plan owners did nothing. They just left the account as it is in hopes of maybe repurposing that money one day for grandkids. But now with Secure 2.0, we have the ability to transfer some of the 529 money into a Roth IRA, provided that certain criteria are met. And that's what's on the slide here. So going through this relatively quickly, the 529 plan must be maintained for 15 years or longer. The Roth IRA has to be in the same name as the 529 plan beneficiary. The Roth IRA owner, the child, let's say, or the 529 beneficiary, has to be eligible to make an IRA contribution in that year. So, for example, they have to have earned income, or at least as much earned income as the transfer amount. The annual limit on how much you could move from a 529 into a Roth is equal to the IRA contribution limit for that year, less any other IRA or Roth contributions that were made. And there's a lifetime maximum amount that can move from a 529 into a Roth of $35,000. Any contributions that were made to the 529 within 5 years of the transfer, as well as the earnings on those contributions, would be ineligible for a transfer. So although there's several requirements that are needed to be eligible for these types of transfers, we see this as adding a lot more flexibility to planning, and potentially can jumpstart retirement savings for younger folks. If you can go to the next slide. Great, thank you. So highlight number 2 is the further delaying of RMD beginning dates. So previously, the Tax Reform Act of 1986 had first established required minimum distributions for qualified accounts. They set that age at 70.5, and that stood for 30 plus years until the first iteration of the Secure Act moved it out to 72. Well, now with Secure 2.0, they have moved the RMD age out again to age 73 for those individuals born between 1951 and 1959. If you're born 1960 or later, the age is actually out to 75. So for individuals or families that don't need to tap into their retirement savings to meet expense needs, Secure 2.0 may offer additional flexibility around tax planning for large liquidity events. It will offer a few extra years of tax deferred growth, and it may help stave off higher premiums for Medicare Parts B and D by deferring paying taxes on that additional income. Sticking with RMDs for a moment, there is also a reduction in the penalty for missed RMDs. Previously, it was 50% of the undistributed amount. Now that has been lowered to 25% of the undistributed amount. And if the taxpayer corrects the issue in a timely manner, that penalty is further lowered to 10%. You want to go to the next slide? Thank you. Final highlight for today is what we're calling the Rothification of retirement accounts. Secure 2.0 allows employers to make matching contributions to the Roth side of employer-sponsored retirement plans instead of just pre-tax. So this money would be vested immediately, but it would be subject to income taxes to the participant in the year that the plan is made, or that the match is made. And again, this is really just part of the Rothification of retirement accounts by Congress, which is them just taking steps to bolster up the retirement savings for Americans. It's important to note that none of these changes are going to restrict or eliminate existing Roth strategies. And also important to note that although these changes are effective immediately, It's going to take some time for plan administrators and for employers to make changes to systems and paperwork and procedures to accommodate those changes. So I hope everyone found that informative, and I'll throw it back to Jennifer.
Thank you, Will. As somebody whose kids are just finishing up their education, I really liked the thoughts on the 529 plan. So I learned something new today. Thank you. Just a reminder that participants can ask questions in the Q&A, and we have a couple of questions, one related to the slides and a particular slide. So we will post this presentation on our website, but to the person who asked it, I do have your name and we'll be happy to send that to you after we finish this call. So thanks for that question. Will, there's another question here about changes to catch-up provisions for folks who are 50 and over. Can you talk about that?
Yeah, there's a lot in Secure 2.0, so maybe there's certainly more aspects that we could expand upon. The catch-up contributions for IRAs, which was for individuals 50 years old or older, currently it stands at $1,000. So you can contribute an additional $1,000 on top of the normal IRA contributions. Starting in the year 2024, though, that's going to be indexed for inflation. So it's been locked at $1,000 for a number of years. Now that's going to start to move up with inflation, and it'll move up in increments of $100. Similarly, the 401k and other retirement plan catch-up contributions will also be indexed for inflation. Great,
thank you very much. Going to Stieg and comments on the financial system. Can you talk a little bit about commercial real estate? And, that's a big topic of discussion now. We're in downtown Boston, most of us, and office buildings are not nearly as full as they used to be. So if you can give us some background, that would be helpful.
Yeah, sure. So I guess before I answer that, it's maybe important to understand what CRE actually is. So it stands for commercial real estate, obviously. And it isn't just office buildings. There are, it's kind of made up of four primary categories. It's office buildings, it's industrial entities, multifamily, which are primarily apartments, and then retail as well. And there are some smaller subsegments of CRE, but those are kind of the four big buckets. And then specifically for banks, they do lend pretty actively within the commercial real estate space. And CRE loan books industry-wide make up about 25% of total loans in aggregate on U.S. bank balance sheets. That's about almost $3 trillion at the end of April. Given, as Jennifer mentioned, given the shift towards working from home, working remotely, vacancy rates have risen in office building. That has impacted downtown retail as well. So office and retail, those are kind of the stress points within the CRE landscape right now. It is important to note that those two together represent about a third of total CRE loans on banks' balance sheets. And so that works out to be less than 10% of total loans in those two stress categories. But stressed is kind of an extreme word. It isn't every office building. It isn't every retail location that's under stress. It's a small fraction. And banks actually actively work to reserve against any losses or any loans that go sour. So they kind of think ahead and position their balance sheet ahead of that. As for what we're seeing right now, nothing yet, to be honest with you. We're hearing anecdotal evidence, a property in Florida, a property in Texas might be going south, but otherwise we are not seeing outsized delinquencies or anything like that. So we are watching it closely. It is important, and we'll continue to watch it.
Great, thank you. We have a question that takes me back to some of my econ classes back in business school. What do you project the impact of the M2 nosedive that the Fed has caused?
Yeah, I think that's maybe a fair intro, Jennifer, that money supply statistics are maybe less leaned on than they were in prior decades, but still have an informative factor to them. And yes, the decrease in M2 is on the list of all of the constricting and tightening liquidity indicators and available stimulus, et cetera, that's out there. So yes, it's as much of its contraction, but also sort of the height that it got to, the peak of stimulus and other, largesse, the coming off of that is going to have some negative impacts, ripple effects, et cetera. And it's certainly on the list of tightening conditions.
Thanks, Dave. I do note that somebody in the conversation has their hand up and we're not able to take questions live. So if you put your question in the Q&A section, we'll be happy to answer it. Have another question. Do we think that bank regulations are going to change as a result of the recent turmoil? And I guess as I say this, I'll certainly give sort of a personal take on working in a bank. Banks, as everybody knows, are very heavily regulated already. And obviously there's likely to be some changes, but I do think that overall regulations work quite well to keep safety and soundness. So with that intro, Steve, what are your thoughts?
I guess in short, absolutely. In fact, we've already seen some impacts, even post the Silicon Valley and Signature Bank failure news. And it was last week that the FDIC announced that they were going to undertake a special assessment on larger banks, mostly $50 billion in assets and above will kind of bear the burden of this, but it's going to be a special assessment that will help to refill the deposit insurance fund that was, it's typically, well over $100 billion, but it was drawn down by about 16 billion because of the 3 bank failures, or really the 2. So they need to refill that by law. So that's the first indication that regulations are changing, but I certainly expect kind of more far-reaching regulations to change, and that's going to involve capital levels and liquidity measures that the federal government, the Federal Reserve, really will require of banks going forward. So yes, regulations will change.
Great, thank you. Question for Marie and or Will. Have we seen people contemplating moves out of Massachusetts because of the millionaire's tax?
I believe it is a concern for people. And if they are concerned, they should speak to their relationship manager about options that hopefully don't include moving out of Massachusetts. But that is on the table for many, especially people who have, vacation homes or second homes in other states. So important conversation. It's certainly out there.
Great, thank you. I think we have answered all of the questions that have been put into the Q&A section. We really appreciate everybody participating with us today, and thank you for joining us. Don't hesitate to reach out to your Cambridge Trust team if you have any questions on this. And as I said, the recording and the slides will be posted in the next couple of days on our website. So I hope everybody has a wonderful afternoon, and we will see you soon.
Thank you.